We're jumping straight into IonQ today. Everyone is watching the price action, but the real story is um, the massive institutional tug-of-war happening behind the scenes.
A huge disconnect.
Exactly. I mean, you've got a stock chart flashing a death cross warning, right?
Right.
It's effectively screaming sell.
So I mean, get out now.
And yet at the same time, you have these huge players like Norway's sovereign wealth fund. They're quietly buying hundreds of millions of dollars worth of shares. It's a complete paradox.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And if you want to stay ahead of these institutional flows, make sure you subscribe and hit that like button. It really helps us simplify the market for you.
Yes.
So let's get into the weeds here. This company has become a battleground for the future of quantum computing. But looking at the tape this week, the narrative is just completely fractured.
It really is.
On one side, you have technical analysts pointing at the chart and, running for the hills. On the other, you have some of the deepest pockets on the planet doubling down.
I mean, you saw the 13F filings.
I was looking this morning. Norway's sovereign wealth fund just dropped $200 million on this stock.
And that happened on February 12th, right? The exact same day the technical death cross triggered.
That's what's so wild.
That timing isn't a coincidence. It's a collision of two different investment philosophies. You have the algo-driven technical traders reacting to momentum signals.
Right.
And you have long-term capital accumulators spotting what they believe is a dislocation.
It's the classic short-term fear versus long-term conviction.
Yeah.
But let's try to validate that conviction for a second. We are recording this in February 2026.
Mm-hmm.
If you strip away the stock price and just look at the business execution over the last 12 months, the picture is radically different from what the chart suggests. I was digging through the Q3 2025 report,
Yeah.
and the revenue velocity is undeniable.
It is. The headline number was roughly $40 million for the quarter,
Right.
but the raw number matters less than the trajectory. That represents a 222% increase year over year.
And crucially, they beat the street's estimates by nearly 48%. That's what caught my eye.
That's a huge beat.
In this sector, you usually see companies just scraping by to meet consensus. A 48% beat suggests the analysts are fundamentally mismodeling the demand curve here.
That's a really fair assessment. I think the analysts have been modeling quantum as a science project with, sporadic grant funding.
Yeah, that's what it feels like.
What IonQ is demonstrating, particularly with that raised full-year guidance of over $100 million, is that this is transitioning into a recurring revenue business. They aren't just hunting for grants anymore. They are signing commercial contracts.
And speaking of contracts, that Air Force Research Lab deal is the one that really signals the shift to me. $100 million. That is not a pilot program or a let's see if this works grant. That is procurement.
It's utility. That's the key word. When the Air Force commits 9 figures, they are effectively saying the technology has graduated from the lab.
Okay.
They need systems that can run actual algorithms for logistics, cryptography, or material science. It's a validation that the hardware is robust enough for real-world application.
Well, let's talk about that hardware.
Yeah.
Because robust isn't usually the word you hear with quantum computers.
No, not at all.
The bear case has always been that these things are too fragile to scale. You look at the competition, IBM, Google, they're mostly betting on superconducting technology. But IonQ is doing something fundamentally different with trapped ions.
Right. And this is where the architectural advantage comes into play. If you look at the superconducting approach, you're dealing with man-made qubits printed on silicon. The problem is that no two man-made objects are perfectly identical at the atomic level. You have manufacturing defects, which leads to noise, which leads to errors.
And the cooling?
Oh, and the cooling. You have to cool them down to millikelvin temperatures, colder than deep space, just to get them to function.
It's an engineering nightmare. You're fighting physics the whole way.
Precisely.
Yeah.
So IonQ, they sidestep that whole manufacturing problem by using nature's qubits.
Okay, what does that mean?
They use individual ionized atoms, things like ytterbium or barium usually, and they're levitated in a vacuum chamber.
So they aren't building them.
Right. Because they are elemental atoms, they are perfectly identical. You don't have to manufacture them perfectly. Nature already did.
And that leads to the fidelity metrics we're seeing. They recently announced 99.99% gate fidelity. For listeners who aren't quantum physicists, we need to underscore why that specific number 4 nines is such a big deal.
It's everything. It's the tipping point for error correction. In quantum computing, errors compound exponentially.
Right.
If you're at 99% fidelity, your calculation just falls apart after a few dozen steps. At 99.99%, you cross a threshold where you can implement error-correcting codes efficiently.
So you can actually finish the calculation.
It means you can run long, complex algorithms without the answer turning into garbage noise.
And that feeds into the AQ score, right? The algorithmic qubits. They hit AQ 64 with the tempo system.
And AQ 64 is the commercial utility benchmark. The theory has always been that once you hit around 64 high-quality, error-corrected qubits, you can simulate molecules and solve problems that are stupid. They're mathematically impossible for even the biggest classical supercomputer.
So we're right on the edge of that quantum advantage era.
We are.
There's another technical nuance here that I think the market overlooks. With superconducting chips, the qubits usually only talk to their nearest neighbors on the chip.
Yeah, that's a big limitation.
But with trapped ions, because they're suspended in an electromagnetic field, you have all-to-all connectivity. Any qubit can talk to any other qubit.
That is a massive efficiency multiplier.
Yeah.
It means you can run algorithms with fewer operations because you don't have to waste time moving data across the chip.
Makes the software simpler.
Much more efficient. Now, the knock on trapped ions has always been speed. They're generally slower to execute a single gate compared to superconducting chips.
But IonQ seems to be betting that slow and correct beats fast and wrong.
That is the bet. And to secure that bet, they are making some incredibly aggressive moves on the supply chain side. We have to talk about the SkyWater acquisition.
Yeah, this is the $1.8 billion elephant in the room. They are proposing to acquire SkyWater, a semiconductor manufacturer. This feels, this is a vertical integration play straight out of the Apple playbook.
It is. And it's a risky one. Most quantum companies are happy to be fabless.
Right. They design the chips, let someone else build them.
Exactly. IonQ is saying, no, we need to own the means of production. By buying SkyWater, they get a dedicated foundry to produce their ion traps and the photonic interconnects they need to scale.
It secures their roadmap. They aren't waiting in line behind Apple or NVIDIA at TSMC, but it also changes the financial profile of the company dramatically. You go from a high-margin software and design company to a capital-intensive manufacturing company.
And that brings us to the financials. Because you can't buy a foundry for $1.8 billion with good intentions. You need cash.
And they have it. This is the part of the bull case that is just. It's the hardest to argue with. They ended late 2025 with a pro forma cash balance of $3.5 billion.
And zero debt.
Zero debt.
That balance sheet is a fortress. In a high interest rate environment, that cash pile is a strategic weapon. Just think about the interest income alone.
I ran the numbers on that. Even conservatively, if they are parking that in short-term treasuries getting 4 or 5%, they are generating roughly $150 to $175 million a year just in interest.
Wow.
That creates a pretty significant floor for their burn rate.
Exactly. That interest income effectively subsidizes their R&D. While their competitors, Rigetti D-Wave, are struggling to raise capital or taking on toxic debt just to keep the lights on, IonQ has a runway that extends for years.
They can afford to play offense.
They can buy SkyWater. They can weather a recession. It's a huge advantage.
So we have the tech, we have the cash, we have the institutional backing. It sounds like a slam dunk.
Yeah.
But we have to look at the other side of the trade because the stock is down roughly 25% year to date. The market is clearly worried about something.
The market is worried about the burn. Yes, they have cash, but look at the net loss for late 2025. It was $1.1 billion.
That is a staggering number.
Yeah.
Even with the interest income we just mentioned, $1 billion loss is hard to stomach.
It is. Now, to be fair, a large chunk of that is likely one-time costs associated with acquisitions and building out infrastructure. But even if you strip that out, the operational burn is high.
Building quantum computers and buying semiconductor fabs has to be one of the most expensive things you can do.
It is.
So the bear case is essentially a race against time. They have a $3.5 billion tank of gas, but they are driving a car that burns 1 billion miles a gallon.
That's the analogy. If they can reach commercial scale and profitability before that cash runs out, they win. But if they stumble, if the SkyWater integration turns into a money pit, or if the tempo system faces delays, they could burn through that cash pile faster than anyone expects.
And if they have to go back to the market to raise more money when the stock is trading at these levels.
That is the death spiral. Dilution just destroys shareholder value.
And speaking of levels, we can't ignore the valuation. Even after this recent drop, the stock is trading at a price-to-sales ratio of roughly 55.
Which is astronomical. The industry average is closer to 5.
Wow.
So you are paying a 10 times premium over the average tech stock.
You are paying for 50 years of current sales upfront. That is price for perfection in every sense of the word.
And it creates a situation where there is zero margin for error. When you are priced at 55 times sales, any earnings miss, any lowered guidance, it results in a massive haircut.
We saw this with the EV stocks a few years ago. The company can succeed, but the stock can still go down 80% as the valuation compresses to reality.
And that valuation compression is exactly what the technicals are signaling. Let's go back to that death cross we mentioned, Feb 12. The 50-day moving average crossed below the 200-day.
What about the volume profile on that? Was it a high volume sell-off?
It was significant but not capitulation volume. What concerns me more is the overhead resistance it creates.
Okay.
Now that the price is below those major moving averages, every time the stock rallies, you have algorithms and bag holders looking to sell into that strength. It creates a ceiling.
And the shorts are piling in.
The short interest is creeping up. There are funds betting heavily that the Skywater deal will distract them and that the burn rate will force a capital raise.
And we can't forget the competition. We mentioned the tech giants, but the pure play rivals aren't just standing still. What if Google announces a breakthrough in superconducting error correction tomorrow? Does that render IonQ's trapped ion tech obsolete?
It's the Betamax risk. Trapped ions might be the superior technology today in terms of fidelity, but superconducting has the advantage of speed and, well, it leverages the existing global silicon manufacturing base.
That's a huge point.
If Google or IBM solves the error correction problem at scale before IonQ can scale up their ion traps, the industry could standardize around superconducting. IonQ could end up with better science, but, zero market share.
So we have a very clear, very binary setup. Technicals look terrible, fundamentals look strong, but really expensive. For the listener holding this stock or think about buying the dip, what are the actual events to watch in the next quarter? We need specific triggers.
I'm looking at 3 things. First, the Q4 2025 earnings in early May.
Okay, and we need to see that revenue number holding up.
Specifically, we need to see revenue hit that $40 million mark again. They need to prove Q3 wasn't a fluke.
Right.
But more importantly, I want to hear the guidance on the burn rate. If they can show that they are controlling costs while growing revenue, the stock will rip. If the loss widens, look out below.
Okay, earnings in May. What's number 2?
The KISTI deployment. This is the system going to the Korean Institute.
And why is this one specific deployment so critical?
Because it represents a business model shift. Up until now, IonQ has mostly sold access to their computers via the cloud, Amazon Bracket, Azure, and so on. KISTI is an on-premise shipment.
So they're actually shipping hardware.
They are crating up a quantum computer and shipping it to a customer's data center.
That changes the revenue recognition, doesn't it?
Completely. But it also proves operational maturity. Shipping a delicate quantum system halfway across the world and getting it to work is a logistical feat. If they pull this off smoothly in 2026, it opens the door to selling hardware to sovereign nations and massive banks who don't want their data on the public cloud.
That's a huge market. And the third catalyst.
The closing of the Skywater deal. There is still regulatory risk there. Semiconductors are a national security issue now.
Good point.
If that deal gets blocked, or if the financing falls through, it leaves a $1.8 billion hole in their strategy. But if it closes, it confirms they are a serious manufacturing player.
So we're watching the May earnings print, the KISTI hardware delivery, and the Skywater regulatory approval. Those are the signposts.
Those are the keys. If they hit all 3, the death cross will look like a bear trap in hindsight. If they miss, the shorts will be validated.
It really frames the paradox we started with. You have the Norway fund betting on the year 2035, and you have the technical traders betting on the next 35 days.
And that's the takeaway. If you're buying IonQ today, you aren't buying a stock. You are buying a call option on the future of computing. You have to be comfortable with the fact that this could be a 0.
Or it could be the next NVIDIA.
Or it could be the next NVIDIA. The volatility is the price of admission for that kind of upside.
A $72 billion market opportunity or a science experiment that ran out of cash. The market is trying to decide which one it is. And that is why we are seeing this violent price action.
Exactly. And until those 3 catalysts play out, expect the turbulence to continue.
We'll be tracking every move. Whether you're a bull or a bear, you can't deny it's the most interesting show in the market right now. Thanks for listening to the Easy Money Show. We'll catch you on the next one.